We're diving deep into a powerful tool that can help you navigate the often turbulent waters of the stock market and come out ahead. So, hit that subscribe button and let's unlock the power of the Buffett indicator together. First things first, let's talk about cash. You might be thinking, cash, isn't that boring? Shouldn't I have all my money in the market working for me? And while it's true that investing is crucial for building long-term wealth, having a healthy cash reserve is non-negotiable. Warren Buffett, one of the greatest investors of all time, understands this principle better than anyone. Right now, he's sitting on a cash pile of over $140 billion. He's not doing that because he's afraid of the market. He's doing it because he's patiently waiting for the right moment to deploy that cash and buy assets at a discount. By having cash on hand, you're not just playing defense. You're setting yourself up for massive offensive opportunities when the market inevitably pulls back. Now, you might be wondering, how much cash should I actually have? Well, that depends on your personal circumstances, risk tolerance, and financial goals. A good rule of thumb is to have at least 3 to 6 months worth of living expenses saved up in an easily accessible account. But when it comes to investing, having additional cash reserves beyond your emergency fund can be incredibly powerful. This is what allows you to buy stocks when they're on sale, essentially getting more bang for your buck. Building cash reserves takes time, effort, and discipline, but trust me, it's one of the smartest financial moves you can make. Remember, in the world of investing, cash is king, especially when the market takes a turn. Let's face it, market crashes can be scary. Headlines screaming about plummeting prices, panic selling, and economic doom and gloom can make even the most seasoned investor feel a bit uneasy. But here's the thing, market corrections are a natural part of the economic cycle. What goes up must eventually come down, and the stock market is no exception. The key to navigating these downturns successfully is not to fear them, but to be prepared for them. And one of the best ways to do that is to identify quality stocks you want to own the crash hits. So what constitutes a quality stock? It's about digging deeper and looking for businesses with strong underlying fundamentals, meaning they're financially healthy, well-managed, and positioned for long-term growth. First and foremost, look for companies with a proven track record of profitability. Check their earnings per share, EPS, over the past several years. Is it consistently growing? Are they generating positive cash flow? These are all signs of a financially sound business. Next, consider the company's debt levels. A high debt-to-equity ratio can be a red flag, especially during economic downturns. Look for companies with manageable debt loads, as this indicates they're less vulnerable to rising interest rates or economic slowdowns. Another crucial factor is the company's competitive advantage. What sets them apart from their competitors? Do they have a unique product or service? Do they have a strong brand reputation? A durable competitive advantage can provide a buffer during tough economic times. Finally, consider the company's management team. Are they experienced? Do they have a good track record? A strong management team can make all the difference in navigating challenging market conditions. By focusing on companies with solid fundamentals, you're essentially buying pieces of businesses that are built to weather economic storms. Remember, investing isn't about trying to time the market perfectly, it's about time the market. By building a diversified portfolio of quality stocks, you're setting yourself up for long-term success, regardless of short-term market fluctuations. Let's be real, timing the market perfectly is the holy grail of investing. Everyone wants to buy low and sell high, but pulling it off consistently is incredibly difficult, even for the pros. But here's the thing. While you can't predict the market with absolute certainty, there are tools and indicators that can give you valuable insights into when the market might be getting ahead of itself, and that's where the Buffett indicator comes in. Named after Warren Buffett, one of the most successful investors of all time, the Buffett indicator is remarkably simple, yet surprisingly powerful. It essentially measures the total market capitalization of U.S. stocks relative to the country's gross domestic product, GDP. Historically, when the Buffett indicator has been significantly above its long-term average, it's been a signal that the market is overvalued, meaning stock prices have gotten ahead of themselves, and a correction might be looming. Conversely, when the indicator is significantly below its average, it suggests the market might be undervalued, potentially presenting a buying opportunity. Remember, the key is to use the Buffett indicator as one tool among many in your investment arsenal. Combine it with other forms of analysis like fundamental analysis, technical analysis, and macroeconomic research to get a more holistic view of the market. We've all heard the old adage, don't put all your eggs in one basket. And nowhere is this truer than in the world of investing. Diversification is one of the most fundamental principles of investing, and for good reason. It helps mitigate risk and protect your portfolio from the inevitable ups and downs of the market. So, how do you actually diversify your investments? Well, it's all about creating a mix of assets that are not closely correlated, meaning they don't move in perfect sync with each other. Here are a few key asset classes to consider: stocks, bonds, real estate, and commodities. The key to effective diversification is finding the right balance of assets that aligns with your risk tolerance, investment goals, and time horizon. Diversification is not a one-time event, it's an ongoing process. As you acquire more assets and your financial situation evolves, it's essential to periodically review and rebalance your portfolio to ensure it still aligns with your goals. By spreading your investments across a variety of asset classes, you're creating a more resilient portfolio that can weather market storms and help you achieve your long-term financial goals. In the world of investing, knowledge is power. The more informed you are, the better equipped you'll be to make sound investment decisions and navigate the complexities of the market. Now, this doesn't mean you need to become a financial expert overnight or spend hours poring over spreadsheets, but it does mean staying curious, asking questions, and actively seeking out information. Fortunately, we live in an age where access to financial information is literally at our fingertips. From reputable financial news websites and blogs to educational YouTube channels and podcasts, there's a wealth of resources available to help you stay up to date on market trends, economic indicators, and investment strategies. One of the best ways to stay informed is to follow financial news from reliable sources. Look for publications and websites known for their accuracy, objectivity, and in-depth analysis. Avoid sensationalized headlines and focus on understanding the underlying factors driving market movements. In addition to general financial news, it's also important to stay abreast of industry-specific news and trends. If you're invested in technology stocks, for example, follow tech blogs, attend industry conferences, and stay informed about emerging technologies and competitive landscapes. Another valuable resource is analyst reports. Financial analysts conduct in-depth research on individual companies and industries, providing insights into their financial health, growth prospects, and competitive positioning. Beyond news and analysis, it's also crucial to have a solid understanding of key economic indicators. These are essentially data points that provide insights into the overall health of the economy. By staying informed about these indicators, you can gain a better understanding of the macroeconomic forces that can influence the market. Investing is often as much about managing your emotions as it is about managing your money. When the market is soaring to new highs, it's easy to get caught up in the euphoria and make impulsive decisions. Conversely, when the market takes a nosedive, fear and panic can set in, leading to costly mistakes. That's why mastering your emotions is crucial for long-term investment success. One of the most common emotional pitfalls investors fall into is fear of missing out, or FOMO. When everyone around you seems to be making money in the market, it's natural to want to join the party, even if it means investing in assets you don't fully understand or taking on more risk than you're comfortable with. Another emotional trap is herd mentality. When the market is going up, it can feel comforting to follow the crowd and buy what everyone else is buying. However, this can lead to buying assets at inflated prices and selling them at a loss when the market inevitably corrects. On the flip side, fear can be just as paralyzing as greed. When the market is crashing, it's natural to want to sell everything and cut your losses. However, this often leads to selling at the worst possible time and missing out on potential rebounds. So, how do you manage your emotions and avoid making impulsive decisions? Here are a few tips. Have a plan, focus on the long term, tune out the noise, seek professional guidance. Remember, investing is a journey, not a destination. There will be bumps along the way, but by managing your emotions, staying focused on your goals, and making informed decisions, you can navigate the ups and downs of the market and come out ahead in the long run. A good advisor can provide objective advice, help you stay disciplined, and keep you on track to achieve your financial goals. So there you have it, the Buffett indicator explained. Now, it's important to remember that no single indicator is foolproof. Here's to making smart investment decisions and building a brighter financial future.